Welcome to The Explainer. Today, we're doing something really fun. We are stepping right into the shoes of an expert investment analyst to put Strategic Education, Inc. through the ultimate valuation gauntlet. We're going to run this company through the exact, highly critical frameworks of legendary investors Warren Buffett, Peter Lynch, and Benjamin Graham, and then stress test it all with some rigorous discounted cash flow modeling. Let's get right into it.
Here's our game plan to figure out if this stock is a buy, hold, or sell. We'll grab a quick baseline snapshot of the business, apply our 3 guru lenses, run the quantitative models, and then bring it all together for our final verdict.
All right, Section 1. Let's establish our baseline for Strategic Education. You probably know them by their ticker, STRA. They're a higher ed provider operating major brands like STRA and Capella universities.
Now, to make sure our analysis is completely airtight, we're pulling our numbers straight from their latest Q1 2026 SEC filings. No guesswork here, just the raw data we need to actually fuel these valuation models.
Okay, so right out of the gate, we've got a really interesting financial conflict. At roughly $81 a share, the market cap is hovering around $1.9 billion. But check out the top-line performance. Quarterly revenue is flat year over year at about $306 million. And their 5-year historical growth rate is a pretty weak 3.6%. But, and this is a big but, they have an incredibly strong 25.3% free cash flow margin. They are generating over $145 million in trailing 12-month free cash flow. So what we have here is a low-growth but high cash-generating machine.
Well, before we can start running the models, we have to talk about the elephant in the room. We neutrally have to factor in their massive recent cybersecurity breach. Over 111,000 individuals had highly sensitive data exposed. We're talking social security numbers, passports, the whole shebang. And critically, this intrusion actually went undetected for 87 days. With class action probes already underway, this is a very tangible, lingering risk that any serious investor has to price in.
So it's a fascinating setup, right? We've got incredibly strong cash flow mixed with undeniable enrollment headwinds and a major costly data breach. How is this going to look to the masters of value and growth? Let's find out.
Moving into Section 2, the Warren Buffett lens. If we're applying Buffett's framework, we are hunting for a durable economic moat, highly consistent earnings, a strong return on equity, and completely manageable debt.
Buffett would instantly spot the tension here. Honestly, the economic moat is weak. The online education market is just fiercely competitive, domestic enrollment is totally flat, and that 3.6% long-term growth is definitely uninspiring. But, on the other hand, the cash generation is absolutely phenomenal. Buffett loves what he calls owner earnings, and STRA's 25.3% margin yields over $145 million in owner earnings, plus they're maintaining a very healthy return on equity between 7.7% and roughly 8.8%.
And here's another massive checkmark in Buffett's book, the balance sheet. He would really appreciate their manageable debt profile. They've got over $150 million in cash and equivalents sitting against relatively modest long-term lease liabilities. They are not over-leveraged, which is exactly what you want to see.
But would the Oracle of Omaha actually buy it today? Because the growth is so sluggish and that 87-day data breach introduces this wild card of uncertainty and potential legal fees, Buffett would definitely demand a massive margin of safety. Without a durable moat to protect those future earnings, he'd probably just sit on his hands and stay on the sidelines unless the price tanked significantly from that $81 mark. So under the Buffett lens, this is a clear wait and hold.
All right, Section 3, the Peter Lynch lens. Lynch loves to categorize businesses so he can understand their behavior, and he heavily weighs growth metrics against price and institutional ownership.
As an analyst using Lynch's playbook, the very first thing that jumps out is the PEG ratio, price to earnings growth. It's sitting at 0.76. Now, in Lynch's world, anything under a 1.0 is generally screaming buy. It means you're paying a really reasonable price for the company's growth.
So we categorize the stock. With 3.6% historical growth, Lynch would peg this as a slow grower or maybe a stalwart. The low PEG ratio and the strong balance sheet are huge pros. Insider trading is a bit mixed, 1 buy from the chairman, 1 sell. But here is the ultimate deal breaker for Peter Lynch. 93.27% of this stock is owned by institutions. Lynch actually views that as a huge negative because it means the trade is crowded. If Wall Street already owns the whole thing, who is left to step in and drive the price up? Because of that crowded ownership, Lynch would also categorize this as a hold.
Section 4. The Benjamin Graham lens. We've got Buffett and Lynch leaning cautious. But what about the father of value investing himself? Let's run this through Graham's famously rigorous quantitative checklist.
This is where it actually gets really wild. Strategic education miraculously passes almost every single point on Graham's defensive checklist. Adequate size near $2 billion? Yes. Strong finances? Yes. Positive EPS of $1.42 in Q1? Yes. A steady $2.40 annualized dividend? Yes. And the big ones, a moderate PE of 14.41, which is under his strict limit of 15, and a price-to-book ratio of just 1.12, it passes with flying colors.
And because it passes that checklist, we get to use Graham's exact intrinsic value formula. It's a classic. The square root of 22.5 times the earnings per share times the book value per share. Let's see what it spits out.
Plugging in the consensus projected EPS of $7.20 and our calculated book value per share of $72.28, the formula gives us an intrinsic value of $108.20. Guys, the stock is trading around $81.58 right now. That is roughly a 24% margin of safety. So Benjamin Graham's strict mathematical framework is absolutely screaming that this is a buy.
Moving on to Section 5, DCF and Alternative Models. Let's leave the investing legends behind for just a second and stress test this using pure, modern quantitative modeling.
For our base case discounted cash flow, we're assuming a 9% discount rate, the standard expected return for the industry. We'll also assume they just maintain that historical 3.6% growth rate in the short term, fading out to a perpetual terminal growth rate of 2%. If you look right at the middle of the table, the base case values the stock at $84.50. That is basically neck and neck with its current trading price of $81.58. So the DCF is telling us it's perfectly, fairly valued right now.
And when we run alternative models, we get a huge spread. A dividend discount model assuming 2% growth gives us a highly pessimistic floor of $34.97. But if we pivot and do a comparable company analysis, assigning a standard sector average 15x multiple to their forward earnings, we get an optimistic target of $108, which perfectly lines up with Benjamin Graham's intrinsic value.
Finally, Section 6, Synthesis and Verdict. We've run strategic education through the gauntlet of the greatest financial minds and the most rigorous models. It is time to step back and make a call.
When we line everything up, we see a fascinating split decision. The pure quantitative value metrics, Graham's formula, and the PE comps are loudly saying buy with targets over $100, but our DCF model, plus the qualitative views of Buffett and Lynch, are leaning heavily toward hold, mostly because of the risks involved.
Let's be real about the business. The strengths are incredible. Massive free cash flow, cheap valuation, passing Graham's rigid checklist, and a solid dividend. But the risks are equally heavy. Flat enrollment, weak historical growth, and of course, the lingering, completely unresolved fallout from an 87-day data breach that exposed 111,000 people. So our final verdict at around $81 is a hold. It's statistically cheap for sure, but the lack of an economic moat and those cyber risks really cap the immediate upside. For this to be a true Buffett buy, we need to see the price drop significantly into the 60s to carve out a real margin of safety.
Which leaves us with this final thought. When a stock perfectly passes Benjamin Graham's strict mathematical rules, but completely fails Warren Buffett's test for a competitive moat, is it a true value play ready to pop, or is it just a classic value trap in disguise? Keep a very close eye on their enrollment numbers and those data breach lawsuits, because those are going to be the real catalysts that decide this stock's fate.